Hello and welcome to the i3 podcast. My name is Wouter Klein and I'm the Director of Content for the Investment Innovation Institute. For more information about our educational forums for institutional investors, please visit our website at www.i3-invest.com. There you can also subscribe to our complimentary newsletter i3 Insights, in which we discuss investment strategy and asset allocation questions with asset owners around the world. Now, as you all know, we love our disclaimers in this industry, so here's ours. This recording is for educational purposes only. It does not constitute financial advice. Please enjoy the show. This podcast was sponsored by BlackRock. As such, the sponsor may suggest topics for discussion, but the final control over the content remains with the Investment Innovation Institute. Welcome to the i3 podcast. I'm here today with Steve Laipply, US Head of iShares Fixed Income ETFs for BlackRock. Steve, welcome to the show.
Thanks for having me, Wouter.
You're welcome. Now, I always look at titles that are a bit unusual, and I think it's interesting to think about. You probably didn't expect to do this when you were a kid. I mean, how did you become a head of fixed income ETFs? And can you tell me a little bit about how you got started in investing?
Well, as far as investing goes, that's interesting. That goes back to actually when I was a kid. I had a job delivering newspapers, and so I would make a bit of money each week. And I was very fortunate to have a father who taught me a little bit about investing, and he told me to save up my money and he would buy me one share of a particular stock. And it's a very interesting stock in 2020 because it was none other than Apple. So needless to say, had I held on to that one share,
So you didn't?
I did not, but that's how I got started in investing. As far as ETFs, that was actually an interesting journey that I think a lot of our clients go through. I was complaining to a colleague one day about how expensive it was to buy treasury bonds through my brokerage account. And this colleague looked at me somewhat incredulously and said, well, why don't you just buy an ETF? And this was back in, I want to say 2003. And my response was, what was an ETF? And she laughed at me and then proceeded to pull up the iShares.com website and show me that there are indeed treasury ETFs that existed. So I thought that was an amazing thing. And that was literally my first encounter with bond ETFs.
Yeah, so you didn't know they existed. And were a lot of people aware of ETFs in those early days?
I don't think so. This colleague was particularly astute, and so she was sort of ahead of everyone else, and she opened up a whole new world of how to access fixed income markets.
Yeah. Now, from what I understand, is that some of the first ETFs were basically set up for tax reasons. Sometimes when you are part of a mutual fund, when you exit and enter, that can then have effect on other members in that fund, and ETFs sort of got around those type of problems. But at the same time, that's sort of a little bit of a retail type of solution. When did you see institutions adopting ETFs, and what is sort of the experience globally with the take-up of ETFs by institutional investors?
Yeah, I think that's right. The initial uptake, myself as an example, as an individual who started buying fixed income ETFs because it was efficient for an individual to do so relative to the bonds, which could be a lot more expensive. I think that was pretty much the prevailing trend up until the global financial crisis in 2007, 2008, 2009. And I think what happened over that period was that, in the absence of well-functioning markets and in the absence of price discovery, particularly in the credit markets, I think a lot of institutional investors became aware of credit ETFs and started literally watching them, if not using them outright. Particularly during the worst of the crisis in September of '08, we've heard a number of anecdotes of institutional investors for the very first time becoming aware of LQD, our investment grade ETF, and HYG, our flagship high yield ETF, and using them for market context during that period of time. After that, I think it started slowly scaling up. And then in particular in the last 2 to 3 years, and especially this past year, we've seen institutional adoption really skyrocket.
Yeah. So has the way they use those ETFs changed, and in particular the fixed income ETFs, since the start when they first started adopting them to now?
Yeah, I think as the products have become larger, more seasoned, more liquid, the amount of use cases that can be applied to them has grown as well. And so initially, when the volumes were lower, as an example, you would tend to see long-only investors buy very small amounts of them just for holding place purposes, something like that. If you look at the volumes that we've seen in the past couple of years, it opens up all kinds of possibilities for investors to use them for tactical positioning, for hedging, for derivative complements or substitutes, for portfolio trades, on and on. So the amount of applications that exist has grown quite a bit.
And I understand they are also sometimes used for tactical asset allocation. How does that work?
Yeah, that is a very important use case and a very important benefit of fixed income ETFs. And you saw that just last quarter during the peak of the COVID-19 induced volatility. As the underlying bond markets became really challenged, it was very hard for investors at the beginning to sell risk. And it was very hard once sentiment turned for investors to get long risk. And in particular, when market sentiment turned positive, that's when we saw a lot of investors very nimbly using ETFs to quickly get back into the market and do so at scale, which would have been much, much harder to do in the underlying market.
Yeah. Now, we are today in a very different type of market environment, very unusual. What has sort of been the experience with fixed income ETFs during the months of March and April, where the markets reacted quite strongly to the pandemic? And have these ETFs remained liquid? Yeah,
so the period of late February all the way through April was a very good data point for what we tend to see in stressed markets. With fixed income ETFs. And that pattern has repeated itself over time. And generally what that pattern looks like is that, in a risk off, as an example, this can occur in a risk on as well, but in a risk off, you can see, asymmetric trading. That is, investors are trying to go the same direction. As a result, liquidity recedes and it becomes very, very challenging to move risk in the underlying bonds. Typically during periods like that, what we also see is that volumes for fixed income ETFs on exchange move up very, very sharply. So as an example, during the first quarter of this year, which would include the worst of that COVID-19 volatility period, we saw about $1.3 trillion of fixed income ETFs trade in the US. That compares to $2.6 trillion for all of 2019. So we saw basically half of last year's volume trade in a single quarter because of that volatility. To put a finer point on that, some other interesting statistics, we would typically see in 2019 around 11 or 12 billion trade in a single day. That's up, by the way, from about 5 or 6 billion, 4 or 5 years before. But during the first quarter of this year, that number was as high as 35 or 36 billion dollars in a single day.
Yeah. Now, one of the questions that I had when the markets froze up, especially sort of in the credit space, these ETFs kept trading. And since they are sort of a derivative of the underlying market, which has frozen up, how accurate are they then representing the pricing in the underlying market?
Yeah, the way I would characterize them, Walter, is that they are actually a portfolio of bonds, but they are through the structure permitted to trade on exchange, and that's very powerful because the individual bonds only trade over the counter in the over-the-counter market, whereas the ETF through that wrapper can trade in the over-the-counter market through the creation redemption mechanism where bonds are exchanged for shares. But then they also trade and mostly trade on exchange as a portfolio in that wrapper. And so because it is actually a bond portfolio trading through that wrapper on exchange, we believe that the price information content is very high. So what you're seeing is a real-time price in very large volume sometimes for a portfolio trading, throughout the day on exchange. And to give you an example, I think March 12th was one of the most challenging days as far as a risk-off market, and it was acute in both equities and credit. And on that particular day, when the underlying market was running into a lot of challenges as far as liquidity and trading, we saw LQD trade 90,000 times, nearly 90,000 times on exchange that day. The largest 5 holdings on average traded about 3 dozen times. So if you look at a price based on 90,000 trades versus a price based on a few dozen trades, I believe that we have more confidence in the price based on 90,000 trades.
Yeah, fair enough. And I think you've used in the past also the example of bank holidays where when that is obviously closed and the OTC market is closed, these ETFs pretty much reflect the price when the markets open again. But I was also thinking those are relatively short time frames. In some of the crises, it can be a lot longer where markets might be frozen. Do you think that it will still hold up over longer time frames where the interaction with the underlying market has been quite a while and maybe investors' memory get a bit short?
Well, that's the benefit of these products is that you are trading the underlying, but you're trading it in portfolio format through the ETF wrapper on exchange. So I don't view it as necessarily losing an anchoring or a tethering to the underlying market. I view it more as the underlying market itself is trading in a different format on exchange. And so because of that reason, that's an incredibly valuable thing when the underlying markets seize up and maybe even for a prolonged period of time. And an example of this would be, if anything, more of a persistent risk off would have been the week, September of 2008, that week that Lehman Brothers declared bankruptcy. That was a very challenging week for the markets. And you saw, although the credit ETFs were much smaller, back then, you saw them trade, again, in relative terms, in much larger volumes than normal, but they traded like that throughout the week. And yes, there were discounts to net asset value, but then you have to ask yourself, what does a discount mean when the underlying bonds are not trading at all, or if they are, they're trading very thinly? And to go back, to our earlier conversation, we would rather put more weight on the price of something that is actively trading throughout that period of time.
Yeah, we talked a little bit about reflecting accurate price, but when I was reading up on this topic, I also saw that you did some research into fixed income ETFs as a leading indicator. Can you tell me a little bit about that?
Yeah, so you may be referring to a paper that we published in, I believe it was 2013, which has been some time ago. I think that paper was called, Bond Market Price Discovery Clarity Through the Lens of an Exchange. I think it was published in the Journal of Portfolio Management. The concept was along the lines of what we were just talking about, this idea that you, through an ETF structure, you have an entire portfolio of bonds that's trading throughout the day on exchange, and that is different than the individual bonds trading discretely during the day, and sometimes maybe not trading on a given day at all. And what we found through that research was because you have this concept of a portfolio trading very frequently, that it does give some information value in terms of the direction of the underlying market. And it's not necessarily that the underlying market is lagging when it does trade. It's because the underlying market hasn't traded yet. And so think of it, think of the ETF price in that context as a window into where individual bond prices may transact, right? Where those prices may actually be set when a trade ultimately does occur, which may take some time relative to an ETF, which is trading constantly. So we found that, depending on the sector, you could see a lead, and this is relative to index values. And the main point here is that because it takes a while for all the bonds to finally trade for an index, which sometimes has thousands of bonds, it could be a period of days, that lead lag behavior.
And I think in the conclusion of that paper, you also said, well, that window sort of enables strategies to be developed on the back of that. What sort of strategies are they? Can they make use of sort of that lag in the market where they just have that information a little bit earlier than anybody else? And has that actually been developed, strategies like that?
Well, I think it's less about a timing strategy per se and more about an actionability strategy. So in other words, you can see in real time, and you saw this in March, and then you saw it, once sentiment turned late in March and into April, you could see the ETF prices moving very quickly. And again, it's not necessarily a direct arbitrage, but it's more of a very quick indicator of where sentiment's turning. So it gives investors the ability, they can see the market turning quickly, where if the best way to think about this is if ETFs didn't exist, it might be much, much harder to see sentiment turning. You may see a bond trade and then another one and then another one, and they're trading up, but they may not be, the price formation and price discovery in those bonds may not be very quick. But you could see that very rapidly through the ETF. So it allows investors to realize that market sentiment is changing quickly. And secondly, if I do want to take advantage of that and participate in that, rather than trying to buy the underlying bonds, which we saw was very hard to do, even when sentiment turned positive, you could implement that trade through an ETF almost instantaneously.
Yeah.
As an example, through something like, HYG or high yield ETF, when people saw sentiment change in high yield bonds, you could actually execute a trade in the ETF, whereas it may have been hard to do in the underlying bonds.
So does those type of strategies, does it affect the underlying OTC market? Can it have possibilities for distortions?
No, we don't believe so. If anything, we think the ETFs accomplish a couple of things. One, they do provide this price discovery, which, when we talk to traders who trade the underlying cash bonds, they've all said that for the most part, that's very useful to be able to see that real time price discovery for that the ETF gives. The other thing would be this idea that because of the ETF existing and because of the idea that there are a number of bonds that are in the ETF, those bonds tend to enjoy better sponsorship in the market than bonds that are not in the ETF. So I think initially, if you go back several years, there were always concerns about, perhaps the ETF could cause pressure on the underlying bonds and may cause unintended consequences. What we found was that bonds that are part of the index that an ETF tracks tend to enjoy better sponsorship. They have better breadth of trading. And it's a very simple function of the fact that there is more activity in those bonds. The ETF is active. There are creations and redemptions, and therefore those bonds will trade, and there's better price discovery and better liquidity in those bonds than may otherwise occur.
Yeah. Now, we often think of tightening regulations to be obstacles to put in place in strategies. But I think in the wake of the financial crisis of 2008-09, some of the tightening of regulations actually increased the demand for bond ETFs. Can you tell me a little bit about that?
So I think it's clear that broker-dealers and banks had to revise their operational models after the crisis. Regulations, part of that, it was just the costs of doing business in trading and warehousing risk went up as well. And so, everybody had to revise their operating models to run at a much leaner, run a much leaner balance sheet than before. And that was just out of necessity, just because of the costs of having a larger balance sheet and a larger warehouse. And, the analogy I like to use, you went from sort of a warehouse model. And if you think of the purpose of inventory in any business, the purpose of inventory is to cushion shocks in supply and demand. It allows you to sort of smooth out when there's too much demand or there's too much supply. Inventory is designed to take up that slack. When you are unable to carry a large amount of inventory, then you switch to more of a just-in-time model. This idea that look, if you want to buy a large block of bonds, I may have some. But for the rest of them, I'm going to have to go out and source those from another investor, and I'm going to have to figure out what price works for that investor and then come back to you. All of that may slow things down and make things less efficient. I think just naturally, investors started looking for other tools which would allow them to be able to put on risk or manage risk much more efficiently and rapidly. And so I think bond ETFs lent themselves very naturally to that idea because you had the exchange liquidity rather than working on more of an agency model in the underlying market. The exchange liquidity allowed investors, for example, to put cash to work very, very quickly. That being said, they could then leg out of that ETF and into very specific bonds as they became available. But at a minimum, it allowed them to stay in the market to earn the yield of a particular sector like investment grade or high yield, and then they could then move on from there when they were able to source bonds ultimately.
I want to talk a little bit about the types of investors that use fixed income ETFs. Are there any sort of institutions that are more attracted to this? I understand, for instance, that insurance companies are quite big takers of these ETFs.
I think initially, if I look back at the pattern of adoption over time, hedge funds were early adopters, mainly because they are much more comfortable across different types of products and wrappers, and they don't necessarily have investment guideline restrictions or things like that. So they're able to use a much more diverse set of products, and so they were the earlier adopters. After that, then you started seeing traditional long only investors, and that included asset managers, insurance companies, and pensions. Insurance companies over the last several years in particular have really ramped up their use. And I think it's for a number of reasons. One, over time, it became more and more challenging to source bonds in the new issue market in the U.S. It's a very competitive situation. And, oftentimes it was just challenging to get, full allocations, et cetera. And so insurance companies were very much keen on using fixed income ETFs, credit ETFs in particular, as a temporary holding place, as I talked about, until they could source the bonds that the specific bonds that they wanted over time. But that lent itself also to this concept of a liquidity sleeve, where then they started holding a more longer term sleeve of credit ETF exposure as a buffer. So if they needed to put cash to work, they could increase the allocation in that ETF. If they needed to raise cash for any reason, then they could decrease that allocation in the ETF. But it was sort of this constant buffer in their investment accounts. And the other thing in the U.S., I think that has hastened adoption with insurance companies. The U.S. regulators at the national level passed some regulations which put bond ETFs more on equal footing with individual bonds and allowed for insurance companies to invest in and carry those bonds, in a way that was very comparable to individual bonds. So that also, I think, was helpful.
Yeah. Now, you mentioned that hedge funds were some of the earlier adopters, and that's just natural because they're probably more quickly comfortable with new instruments and new strategies. I believe that these ETFs also are used in that context for relative value trades. Can you tell me a little bit about that?
Yeah, so this is, as the products matured, we talked about this earlier, it became a lot more liquid. It opened up this concept of relative value. And the way we would think about that is going long one instrument or short another. It could simply mean just preferring one instrument over another at a given point in time, but it can also mean a pairs trading concept. And where we see this would be more commonly in credit. So as an example, we saw in the, sort of the worst of the volatility in March, we saw the CDX basis versus cash widen out to about 300 basis points. So cash was a lot cheaper because of the pronounced sell-off going on in the underlying cash bonds. And that would lend itself into an opportunity if you believe that basis was going to narrow. You would get long the underlying cash bonds, and then you could buy protection on CDX as an example. But that was harder to do precisely because of the reasons why credit spreads were so wide. Liquidity was very difficult, which is part of the reason why you saw this sharp increase in spreads. The solution for that then was to, instead of trying to buy all the cash bonds or a large amount of them, you could simply buy a credit ETF like LQD, and then you could as your cash bond index proxy, and then you could buy protection against it and take advantage of a narrowing in that basis.
So it's basically another tool in the toolbox that you can use when the opportunity arises.
That's right. We speak with a number of active managers who describe it exactly like that. They refer to it as a toolkit, or another way to refer to it as a dashboard. As an example, our own investors describe it as, if you have a view on a given day, you come in, you decide you want to be long credit, you have an array of tools that you look at. You have cash bonds, you have derivatives, you have ETFs. In that particular case, depending on the size you want to do, what is the cheapest, most efficient way to express that view? Likewise, if you want to be short.
Yeah. Now, often when I talk to investors, the very nature of ETFs is the fact that they are a listed vehicle. But because they're listed, they're also subject to the sentiment in the market and sometimes the panic in the market. And they behave a little bit more like the rest of the market. This is particularly a criticism, I think, of real estate investment trusts, where they sometimes say, well, it's almost more like an equity than a property type of holding. What is your opinion on that in relation to fixed income ETFs? Is there a chance, is there times that they act more like equity?
Now, again, it's a little bit, it's a similar discussion relative to the price discovery conversation. We firmly believe that the ability for something to trade has value. In other words, just because it trades on exchange doesn't transform the character of the asset class. We view it as an incremental benefit having two places to trade, that being the over-the-counter market and the exchange, versus only one place to trade. And so we view this exchange-traded feature as a very, very powerful benefit of the structure. And as we discussed earlier, as an example, on a day when the bond market's closed, the ability to still be able to trade treasuries, credit, municipals, emerging markets, all of the above, the ability to trade that on a bond market holiday has tremendous utility. Or, like we saw in March, when markets are really experiencing difficulty, the ability to trade, fairly significant amounts of risk at tighter spreads than the underlying, that has a benefit. So we don't really view the fact that it trades on exchange as somehow changing the character of the underlying fixed income asset class.
Now, we've talked about the use of these ETFs in multiple contexts, the relative value trades as a holding asset to remain fully invested. Can it also be used for risk management in sort of as a hedge?
Yes, so this is becoming an increasingly prevalent dynamic. And where we see it is in the very rapid growth in options on the ETF, listed options. We are seeing increasing numbers of investors using these options as a way to either protect portfolios or to enhance long exposure that they're taking. And then, of course, as we discussed before, there are options relative value strategies, whether that's within the credit ETFs options themselves, or interestingly, you are starting to see sophisticated players put on trades where they are, for example, long credit ETF vol and short CDX vol, or vice versa, things like that. So that market has really grown. As an example, HYG options, now trade hundreds of millions of dollars in notional a day, and it continues to grow.
Yeah. So I think the first fixed income ETF was launched around 2002. We've seen a lot of development since then and a lot more sophisticated use. If I can ask you to do a little bit of crystal ball gazing, where do you think we're going in the next couple of years?
I think that probably where you'll see the most innovation, you will see more and more actively managed fixed income ETFs. We're already seeing that. But I also think you'll see a surge in what we would call factor-based ETFs and sustainable, or ESG. So first, on the factor front, I think there is a desire to be able to isolate and use fixed income factors for portfolio construction. So at a very high level, being able to isolate credit risk factors. We do have a couple of credit ETFs, both an investment grade and a high yield ETF that will screen on both quality and value. And so if investors have a strong view on those factors, that would be a way to position for it. We also have a macro factor ETF, which basically seeks to balance credit volatility and interest rate volatility, as an example. So I think you'll see more granularity in that space because investors are beginning to realize that, instead of looking at a portfolio and saying, well, I have 1,000 bonds in it, and these are all actively managed positions, what they're really seeing as they step back, this portfolio has some amount of beta. This portfolio has some amount of static credit factor risk. This portfolio has some amount of interest rate volatility risk that's static. Oh, and then yes, I do have idiosyncratic alpha. And the real question is, well, rather than going out and buying 1,000 bonds and paying all that bid offer, can you build those component pieces of it much more cheaply using the beta and factor ETFs, and then spend your risk budget and your money, your transaction cost money, on the idiosyncratic alpha where you're adding the most conviction? And I think we're going to see a lot of that. The ESG front too is exciting. We're seeing more and more innovation along that front. And we recently, it's small relative to ESG and equities, but we recently crossed $1 billion in the U.S. Sustainable Sweet and Fixed Income for iShares.
Yeah. So these ETFs, they're becoming increasingly more granular. There's more sophisticated ways of applying them. Now, this might be a bit of a theoretical question, but do you think we will ever see an institutional grade portfolio that's built completely out of ETFs?
Well, I think you do see elements of this already. As an example, in the U.S., the proliferation of "quote unquote" model portfolios. There are firms who, this is their business. They build entire portfolios out of ETFs. I think that, at the limit, for example, if you take an asset manager who is running a core plus strategy as an example, I do think there is a role for all of the above. So would I envision that to be ever 100% ETFs? Probably not. But I do think rather than seeing 99% of it being individual bonds, I could see a future state where quite a lot of that portfolio is what we just talked about, components of beta ETFs, components of factor ETFs as an example. And then, again, some high conviction positions in individual bonds for alpha.
Yeah. Excellent. Well, Steve, thank you very much for this interview. It was very interesting.
No, thank you, Walter. Thank you for having me.
Thank you for listening to the i3 podcast. For more information, please visit www.i3-invest.com. Thank you very much.